1992. That's the last time the Federal Reserve saw this level of internal dissent. It just happened again, and most investors don't realize what it means yet. Here's what's really going on and what you should be thinking about right now. The Fed held rates steady. That sounds calm. It is anything but. Inside that decision was the highest level of internal dissent since 1992. That's over 3 decades of relative consensus, shattered. Sticky inflation is back on the radar. Prices are not cooling the way the Fed needs them to. That is the core problem right now. Bond markets are moving. Rate hike expectations are repricing in real time. This is not a drill. Business Insider is now reporting a Fed rate hike is back on the table. Not a cut, a hike. Let that sink in. Rate-sensitive sectors are getting hit. Real estate, utilities, any dividend-heavy equity is exposed right now. And then there's this. Reports are circulating that Kevin Warsh could replace Jerome Powell as Fed chair. The Motley Fool is calling it a potential major stock market problem. Growth stocks are pricing instability. A leadership change at the Fed breaks that assumption fast. But here's what nobody is saying about this yet. The 1992 dissent didn't just signal a policy debate. It signaled a structural turning point in how the Fed communicated with markets. We may be entering another one right now. When the committee cracks, forward guidance loses credibility. And when guidance loses credibility, volatility becomes the new baseline. That's the real story here. Not just whether rates go up, but whether investors can trust the roadmap at all. First, duration risk. If you hold long-duration bonds and rates move higher, your principal takes a hit. Review your fixed income exposure today. Second, sector sensitivity. Real estate, utilities, and long-duration growth stocks are all in the crosshairs if a hike materializes. Know your exposure before the market prices it in for you. Third, Fed chair uncertainty is a wild card. A new chair can shift tone, language, and policy direction. Warsh is considered more hawkish than Powell. Factor that into your macro outlook. 32 years of consensus just cracked open. A rate hike is back on the table. A Fed chair shakeup is in the air. What does this mean for your portfolio? Drop it below. This conversation is just getting started. This video is for educational purposes only, not financial advice. Always consult a qualified advisor before making any investment decisions.